How do banks control and monitor credit limits? Have you ever wondered how your credit limit is decided? The exact details are kept tightly under wraps by each institution, but here are some helpful hints. What is a credit limit? A credit limit is the maximum amount of money you can spend on your credit card. A high limit allows you to purchase expensive items, but can get you into trouble easily. How are credit limits determined? A high limit means the bank considers you low risk. You're a good borrower. If you seem like a high-risk borrower, they'll give you a low limit to start. When applying for a credit card, the card issuer checks your income and your credit report to determine what your limit will be. Card issuers want to see if there are bad marks on your report, bankruptcies, missed payments, late payments, tax liens, etc. Your debt-to-income ratio plays a role. If you have a long work history and low debt-to-income, you'll be seen as low risk and given a higher limit. How do credit limits affect credit scores? Credit card limits directly impact your credit score. One of the ways it does this is your debt-to-credit ratio. This ratio is important as it comprises 30% of your FICO credit score. What about going over limit? Going over the limit takes your debt-to-credit ratio to over 100%. It's important to understand how credit limits work and how they can impact your credit score.
Check out the Phenix Group blog for more helpful tips at thephenixgroup.com/blog.